Germany just unleashed a terrifying warning. Their economy's doomed as it's crashing under a massive threat. The dominoes falling fast, and they're warning the rest of the world is next. Stay tuned. And while Germany's economy teeters, yesterday's machine position report nailed a trade that's up almost 4% in 2 days. Want to profit as the world shakes? Stay tuned to the end of the show. Now, let's head over to CNBC where we find out what's coming for the rest of the world. As U.S. tariffs could thrust Germany into a recession, the central bank governor says, but he said we're not the only ones as the rest of the world is under threat. I'm going to show you exactly why we could see the global economy come toppling down and much faster than the experts believe. U.S. tariffs could push Europe's largest economy into a recession. This from German Central Bank President Joachim Nagel. Now we're in a world with tariffs, so we expect maybe a recession this year if the tariffs are really coming. And this is a massive threat that's not just facing the German economy, not just the European Union, but the entire global economy, and that is a tariff and all-out trade war. And what he's telling us is something you never hear from central bankers. He's saying a recession is coming. And what that means for the ECB is they're going to slash rates, demand's going to come down, and unemployment is going to rise. But the problem is Germany's warning what's happening there is coming to the rest of the world, and soon. As global tariffs are set to exacerbate the existing symptoms of what Nagel says is described as Germany's stagnating economy. And we talk about stagnation, we talk about slowing growth and rising unemployment. And those are issues that's facing Germany, but it's also a problem that's starting to spread all across the world. And their economy has contracted for 2 consecutive years amid the combined aftershocks of the COVID-19 pandemic and the energy crisis triggered by Western sanctions on Russia for its 3-year invasion of Ukraine. And you can see the issue when things like energy prices rise, it leads to lower consumption by consumers because they have to adjust their spending. And now the problem is the tariffs are about to hit, could put a lot of German workers on the unemployment line. At the same time, it drives inflation higher. But the issue here isn't what just going to happen in Germany and other parts of the world. What they're saying is this is coming to America and it's going to hit U.S. consumers and hard. But let's take a look at the S&P Global Germany Business Outlook, because on the headline, their growth outlook remains subdued despite optimism returning to manufacturers. Well, if you're in a depression, yes, anything looks better, but it's not what they're saying, it's what they're doing. Despite forecasting an upturn in output levels, German manufacturers signaled their intention to trim payroll numbers over the next 12 months, pointing to targeted improvements in productivity. And it's not just about productivity. Yes, that happens as workers are on the job longer. The bigger issue here is the contraction in demand. The global economy is shrinking and demand from consumers is falling under the weight of higher prices, and that's what's really plaguing German manufacturers. But it's not just them. It's plaguing manufacturers all over the world, and this is going to spread and spread quickly. But while German manufacturers are looking optimistic, so should your trading account. Check out this trade we put on the report yesterday. This to our CTA Time Pro subscribers. We said buy right here. You can see the notes that were published with the report. It said buy it open. It's right here. That trade now up over 4% as of the time of filming. And look, my friends, you can jump in too. Just because the market is shaking and the global economy is weakening doesn't mean there's opportunities in this market for you to make money. Stay tuned to the end of the show or hit the links in the description. Grab the coupon codes for a 30-day free trial, because what's happening in Germany is prices are expected to rise as demand goes down. And this is what happens every time throughout history is you go right into a stagflationary recession. Let's go back to the 1960s where we see the consumer price index in blue is rising. And initially it doesn't hit the labor market, but at one point demand starts to weaken. And what happens? Next thing you know, the unemployment rate shown in red heads higher right into recession. You see that happen again going into 1975. How about in 1981? You see the same trend starting to build right into that recession. And then we had a second recession as inflation remained too high and the labor market couldn't adjust to those prices. We had it happen again going into the 1991 recession. Prices rising again. At first it doesn't hit the economy, and then all of a sudden it spirals out of control. We see it going into the dot-com bubble, the global financial crisis. And what we're hearing from CEOs, manufacturers, and service providers is that tariffs are going to drive consumer prices higher. Demand's likely to fall. That means the unemployment rate is going to head higher in the U.S., but it's going to happen all over the world, because the issue here, my friends, it isn't just about tariffs. The reality of the story is the economy around the world has to contract to the level of demand. So it doesn't matter what causes prices to head higher. The issue is consumers can't afford them. And this is not good policy, Nagel said, as it's a tectonic changes now facing the world at large. And if you're frustrated about the direction of the global economy and what's about to hit the like button, weigh in the comments. What do you think is going to happen? What should we be doing instead? I want to hear from you, because I hope there's an understanding within the Trump administration that the price that has to be paid is the highest on the side of Americans. Now, do you agree with that? Do you think American consumers are going to pay the biggest price here, or do you think it's the rest of the world that's going to pay? Because the reality is it comes down to what we're focused on. It's whose economy is the strongest, who can weather the trade war the longest. And right now, it doesn't appear that Germany is going to be able to. As they go down, they're going to pull the rest of the European Union down with them. The question remains, can the U.S. economy hold up long enough or not? Weigh in the comments below. Love to hear from you. As the world's third largest exporter, according to 2023 data, and numbering the U.S. the foremost importer of its goods, Germany is especially vulnerable to tariffs, which could erode its automobile and machinery sectors. Well, the automobile sector is already reeling. We're seeing demand plunge as auto prices go up. But that's not the only issue. The work from home movement means people are driving less. Boomers heading into retirement means they're also driving less and want fewer cars. But there's other factors. The cost to even own a car is rising, to maintain it, to insure it, and that's a problem, which is why we're seeing the delinquency rate surge higher. As we look at auto loans that are 60 plus days in delinquency, you notice for subprime consumers it's a 6.6%. This is the highest level since this data series began. You can go back to 1995, where we're facing then what was believed to be a soft landing. It was just a preview to the dot-com bubble. We see that auto delinquency surged. They pared back a little bit and then sent us right into the dot-com bubble. You see it happen going the global financial crisis. You can see it building into the pandemic and now at the highest level. So what's that telling us is that consumers aren't buying cars anyway. So if you think about Germany's automobile sector, it's going to take a hit no matter what. And by the numbers, 6.6% of subprime auto borrowers were at least 60 days past due on their loans as of January 2025, the highest level since the agency began collecting data. The fall and winter of 2024 saw the next highest of subprime delinquency rates. Again, a major factor impacting demand, because if you think about it, consumers can't buy a new car if they can't afford their old car. And that's a problem, because car insurance rates are up a whopping 19%, while repair and maintenance costs have risen 33% since 2020. And if you're frustrated by rising insurance rates, hit the like button. I want to know, are you shopping your insurance rates? Are you getting rid of cars? What are you doing to mitigate the impact of higher vehicle expenses? Weigh in the comments, because cripplingly, exports of goods and services accounted for 43.4% of Germany's GDP back in 2023. Although this is typically high for a foreign trade surplus, it most recently slimmed to 16 billion euros in January, compared with 20.7 billion euros in December. So what is that telling us? The global economy is slowing down. Again, the issue here is because wages aren't keeping up with inflation, and we know prices are likely to go higher, the global economy has to shrink to the level of demand of consumers. The problem is it's going to contract, and a lot. And take a look at automobile sectors. Well, BMW's got problems as they post a 37% drop in annual net profit, warns of subdued Chinese demand. So it's not just the tariffs that are plaguing Germany, it's the lack of demand from China. So we've seen China's economy slow in a big way. Of course, Chinese consumers used to love buying German automobiles. Now they're buying Chinese vehicles, but the problem is even their consumption is slowing, because as the global economy weakens, well, demand for Chinese goods falls, and that means for Chinese workers, the opportunity to make money and spend in the economy also goes down. And here's a factor that's facing BMW. Is going to face companies all over the world. As profits slow down, well, it means they're going to lay off, despite the fact that we noted that President Trump brought in 100 top CEOs from this country, had a meeting with them, and you know he told them, don't lay off. He said, look, my grand plan is very simple. It's going to work out, but I need you to be resilient here. I need you to hold on. But the reality is, as profits go down, companies look to make changes, and the biggest one well, is with their labor. And here you can see, going back to the 1981 recession, what happened? Corporate profits were decelerating, ultimately contract. What happened? The unemployment rate headed higher. You see it happen again in the second recession in the 80s. It wasn't just inflation. Well, corporate profits didn't rebound, so they laid off more people. You can see it happen going into the 91 recession. Corporate profits started to decelerate, but it wasn't until they contracted the company said, we've had enough and we don't need you anymore. But how about going into the dot-com bubble? Well, profit growth was slowing and it didn't really impact the economy as employers didn't lay off a lot. Now, mainly the real estate sector helped a lot here, but the reality is, as corporate profits continue to remain in contraction, eventually it hit the labor market and the real estate sector. But let's take a look at what went into the global financial crisis. Corporate profits slowed, went into contraction. What was the response? The unemployment line for a lot of workers. And here we can see the corporate profits are rolling over once again, expected to turn down. What does that mean for U.S. workers? What does it mean for workers all over the world? Well, it means a lot of them are going to lose their jobs. And BMW deliveries totaled around 2.45 million units last year, slightly down from the 2.55 million of 2023. And here's the reality is that number is going to go down even more because as demand for vehicles goes down by consumers from all over the world, it means production needs to fall. As production goes down, well, the need for employees goes down as well. And ECB's Lagarde warns of severe global fallout from the trade war, suggesting what's happening in Germany is indeed going to spread to the rest of the world. And if we were to go on a real trade war where trade would be dampened significantly, that would have severe consequences, she said, for growth around the world and for prices around the world, but particularly for the United States. So once again, they're saying, look, the United States is going to bear the brunt of the pain. Now, I don't agree with that. I don't think that's how it's going to play out. I think a lot of other economies are going to fall first before we do. If you agree with me, hit the like button. If you don't, weigh in the comments below, because what she's saying here is things are going to get worse, meaning demand is going to go down even more because growth is going to fall. And it starts to make perfect sense. As prices go up and wages don't keep pace with it, well, the only thing that can happen is demand has to go down. And we can take a look and validate this on this chart right here as we look at the consumer price index in blue against total income of production and non-supervisory employees in red, a function of average hourly earnings multiplied by average weekly hours. And what do we see in the 91 recession? Prices rising, but income growth slowing, meaning they couldn't afford higher prices. Demand went down and the economy had to shrink. And the only way you do that is you go into a recession. You see that happen in the dot-com bubble. Once again, prices rising, incomes falling, consumers can't keep pace, demand goes down, economy shrinks, and then you saw it once again going into the global financial crisis. In fact, you kind of see this recipe going into every recession. Energy prices sent the consumer price index up. Incomes didn't keep pace. Consumers had to spend more on energy, less on discretionary, and the economy had to contract down to the level of demand. And here we're facing it once again, what the ECB, what Germany's central bank president are saying, look, prices are going to go up. There's going to be a cost. Everyone's going to pay. And yes, Americans are going to get affected, but I don't think it's going to be as bad as everywhere else. But that, of course, remains to be the question. Can things turn around quick enough? I'm going to tell you the playbook here. I think I'll tell you what I think President Trump's going to try to do. I don't know if he's going to pull it off, but if he engineers a U.S. recession, think about what's going to happen. Congress is going to open up the checkbook. Maybe he gets his tax cuts, and next thing you know, the U.S. economy experiences what would be a soft landing and turns around. The risk here is, what if we don't and unemployment spirals out of control? What do you think the outcome is? Do you think he pulls it off, or do you think we're doomed to either way? Love to know. Weigh in the comments, because any trade war is going to hurt the global economy. The initiator, the retaliator, the re-retaliator, and so forth. All of it's going to hurt growth at large, and that is true. Everyone will suffer. This is a constant in history of trade. Some countries will be hurt more than others. Some countries will see inflation move more than others, but everybody is to lose as a result. But again, there's always somebody who's going to lose bigger than others. And the question is, whichever country goes down the first and the fastest will be the one that comes to the negotiating table and is ready to make a change. The question then remains, can the U.S. keep out of what is the downward spiral of the global economy? Can we get this done fast enough? I don't know, but I'd like to know from you, what do you think the outcome is going to be? Are we headed to a recession, or Does President Trump pull this off? China's economy forecast to show resilience as trade war begins. Well, the problem is this is spreading to the rest of the world. As Germany's central bank president said, everybody is going to pay the price. China's saying they're going to be immune. I don't think so for a minute, because evidence that the world's #2 economy is withstanding trade war headwinds comes after President Xi Jinping's government this month set a record deficit target and maintained a bullish annual growth of about 5% for 2025. So look at the response of the Chinese government. Hey, we're just going to borrow a bunch of money, take on a lot of debt, and pump it into the economy and hope it works. But here's the problem. What if it doesn't work? And my friends, I'm going to tell you, it isn't going to work. That's the problem. So going into the next global recession, not only is China's government going to be loaded up with debt, but look around Europe and the United States. We have massive debt levels. And the only solution for recessions is governments are supposed to take on even more debt and spend our way out of it. The problem is they're already over indebted. The answer is there's going to be a major adjustment period far longer than anyone thinks, because China's inflation turned negative in January to February for the first time since 2021. So what is that telling us? Demand from Chinese consumers is going down. So injecting money in the economy isn't going to structurally fix the problems of China's economy. It's just going to add more debt to the government. And while an earlier than usual national holiday helped push price growth below zero, the downswing was sharper than predicted. Imports unexpectedly fell 8.4% at the beginning of the year. Again, here's the key part, indicating weak demand. The issue here is demand from all over the world is going down. What's going to happen is the global economy has to shrink to the level of demand. The problem is, coming out of the pandemic, there was a lot of pent-up demand from a lot of government spending. The day of reckoning, my friends, is coming. And the collapse of the housing market in China over recent years has dragged down activity and remains one of the biggest pain points in China's economy. The crisis contributed to deflationary pressures as it hits home prices, where Chinese consumers store the vast majority of their wealth. And again, all this money that China's injected in their economy hasn't turned things around. So you can see Germany's warning, look, their economy is doomed, and what they're telling the rest of the world, look, you're next. And sure enough, we can see that. But you should be the next to be making money in this market. But despite the fact that U.S. equities continue to be on a downward trend, we dropped this trade to our CTA Time Pro subscribers yesterday. We told them to buy it open right here. And 2 days later, they're looking to be up over 4%. And how do we know? What do we do? Well, every day we run a screen of machine positioning across the broad equity, bond, currency, and commodity markets. But we do one thing different than the machines. We run a historical overlay so we know where they should be positioned instead of where they're actually positioned. So we know whether they should be buying or selling. And when these trades come through, well, I review them and tell our subscribers what I think. And this one has taken off. Looking for more upside. Here you can see a report from back in January. We have a hot list because we've taken that back tested data and we've run it into the report. So when we see a hot trade, it shows up. I review it and publish it to our subscribers. And what are we looking for? Well, we're looking for changes in machine positioning. We're looking for when they're going to be big buyers or sellers, so we can position our subscribers to buy ahead of when they're buying and to sell before they start dumping. You get the daily report. You get all the signals. I go through and give you my opinions on the best trades to take. We've done a full back test on the report. We give you risk control levels. We track and update our open trades every week. Plus, I disclose my trading book to you. And on top of that, we're so confident you can make money trading this report. We give you a 30-day free trial. Jump on the links in the description below. Be sure to use a coupon code for your 30-day free trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.